what I'm going to be talking about is providing some insight into how a growing segment of the PE market is evaluating businesses, essentially by looking to the customer data and analyzing it in the right way. And then I think this will also be relevant for getting some sense for what we're seeing, at least for a few of the analyses that we've done about kind of overall market conditions. If you move forward a slide. A little bit about kind of me and some of my background. I'm an assistant professor of marketing, so I've written a number of papers that have won a bunch of awards, kind of tying customer-based activity to overall corporate valuation. I've also co-founded two companies. I co-founded a company called Zodiac, a predictive analytics software as a service firm that used some of my statistical models along with Wharton professor Peter Fader. This was a marketing company, so we primarily help marketing departments make better tactical acquisition retention decisions. We grew it and sold it to Nike in March of 2018, and then subsequently co-founded Theta. Theta, I think, is much more relevant for this audience. About half of our revenue comes from private equity. These are just some of the brands that we've been allowed to share that we've done work with. And as you can see, there are now a number of corporates because the non-compete with Nike has expired, but there are also a number of good private equity firms that we've worked with too. And again, the main thing that we focus on is applying this customer value lens I'm going to talk about shortly. If you can move forward a slide. So at a high level, when you think about the PE diligence process, obviously they're all going to have their standard, valuation spreadsheets, whether they're looking at multiples of revenue, multiples of EBITDA, or laying out all the free cash flows through some sort of a DCF model. And what's interesting is oftentimes the companies themselves that are being evaluated, they'll put in their data room, especially kind of the later stages of the diligence process, customer data. Oftentimes it's the full transaction data set that they have along with the CRM data. Sometimes it's summaries of that. And the fundamental claim that I'd make is, let's use that. There's information there and it can help us understand whether an investment can be promising or not. And so increasingly, the investors have been asking for this data, and we've been helping them incorporate that into their diligence process. So if you just move forward one. So essentially, the way you can think about it is we're kind of taking that standard framework, but we're essentially exploiting an accounting identity that revenue has to come from customers who are making purchases, and there's some spend associated with the purchases. And we'll just apply statistical models to forecast the future evolution of customer adoption, the retention of existing customers, order frequency, spend, all the way down to the individual level, and then aggregate it up to get our enlightened revenue forecast. If you can move forward one slide. So just to kind of very quickly describe what we do, we'll kind of take whatever data is available. It could be internal data, again, transaction logs, CRM data. It could be aggregated summaries thereof. So oftentimes we'll have cohort triangles that represent, for each of your different acquisition cohorts over each of the time points, how many customers are active, how much revenue you're getting, et cetera, et cetera. And if you can move forward, just one. What we're going to do is we're going to run that through a series of statistical models. So I'm formerly a statistician by training. I've got a PhD in statistics. And again, it's going to be for those different behavioral processes that bring about revenue. If you can move forward one more. And what we're going to do is we're going to take those models, and what they'll give us is essentially a prediction for what every customer will do. So you could think of them as the rows in every single time point. And so if we kind of had that data and we had customer acquisition costs and we had margin data, ideally at the transaction level, we can get things like customer lifetime value, CLV to CAC, and all the rest of it at the segment level, even at the individual customer level. But then we can also use that same sort of a model to get future revenue projections and have that drive a DCF model. If you can move forward one slide. This is just one super quick example. So Warby Parker, they had done their public offering in September of last year, so about a year ago. And we actually did our analysis of them before they put out their reference price. So we were really flying blind. They had put some very good data in their filing. We ended up concluding that their fair value was about $22 a share. They came in at 54. And maybe if you could just move forward one. What we had done was we had run our analysis off of all of the public data that they provided in their S1 filing, the filing that they put in before their DPO. And so again, we're going to train our model here. It's kind of the ultimate stress test because we're very far from having all the granular data. We just had whatever aggregated summaries they put into the IPO prospectus. And if you can move forward one. We then ran that through the same sort of statistical models. We validated those models to ensure that they capture all the variation that's worth capturing. And we concluded things like, what is their CLV to CAC? What is their implied marketing return on investment? How are they doing in terms of first purchase profitability? And if you can move forward one. And what we concluded was, again, first that their valuation was something like 22. Our estimate of their fair valuation was 22. So when they began trading at 54, we were a bit cautious on the valuation, even though we actually thought their underlying economics were pretty good. And I'll have a little bit more to say about how things have evolved since then very shortly. So if you just move forward a slide. So again, this is just a sample of the sort of data that they provided. Again, in a PE diligence setting, we'll typically get much richer data than this, but the one I really want to call your attention to is the one in the top right. This is giving us data about revenue retention by customer cohort. And so we can see for each of the different kind of cohorts of customers that made their very first purchase in different years, how those customers have monetized over 1 year, 2 years, 3 years, 4 years. And this really helps us be able to identify the sort of statistical model that we would use to understand what it all means for customer lifetime value. If you move forward a slide. So what ended up happening? We put out our analysis, and again, we were somewhat gloomy on the valuation. If it bleeds, it leads. So obviously ended up getting a lot more media attention than if we concluded that their valuation was justified. Their valuation has fallen significantly since then, including before all the recent turmoil that we've been going through. But if we kind of roll forward even further, if you could just move forward a slide. Yeah, what you'd see is that they actually, and maybe just move forward one. So again, we came in at 22, they came down to 22, and then they subsequently plummeted way below 22. So they traded almost as low as 11, so about half of what we had originally estimated. And so in August of this year, we said, maybe we should take a second look. And so we went back in, retrained our model on all of the newly available data. And if you just move forward one. What we found was that our revised fair valuation estimate was about 20, so a little bit lower. Even when we kind of stress tested our assumptions, we were still coming in north of 17. And so 11 seemed low. But I think this is also indicative of a lot of what Emmett had been alluding to, that valuations have been coming down, but also they've been coming down to the point that whereas we had been almost laughed out of the room, back when they were trading at 54. Now we're actually coming out bullish, and so it could be, again, if we're correct, that there's room for upside in terms of valuations here. If you can move forward a slide. So that's pretty much it for me. I think that this sort of methodology can be very useful for you. Obviously, we'd love to speak with you, as you could see, both if you're trying to set yourself up for success to look good as part of an acquisition process. I think that this sort of methodology, it can both help you make the decisions that you want to make to help the metrics look better, but also how you can kind of best set yourself up for success and put the right measures out there that won't expose your flank, so to speak. So thanks so much, and looking forward to questions at the end.